There is a silent crisis happening in the financial world right now, and most people have no idea it is unfolding. Every month, millions of people across the United States, Canada, the United Kingdom, and Europe are losing purchasing power while they sleep, and they believe they are being responsible with their money. They are keeping it in the bank. They are doing what they were told to do, and it is quietly costing them a fortune. As of February 2026, the national average savings account in America pays just 0.6% annual percentage yield, according to Bankrate's latest survey. The FDIC's own published national average is even lower, sitting at 0.39%. Meanwhile, the annual inflation rate in the United States slowed to 2.4% in January 2026, according to Bureau of Labor Statistics data released just days ago. That means if your money is sitting in a standard savings account at a major bank, you are losing roughly 2 full percentage points of purchasing power every single year. On $100,000, that is $2,000 of real value vanishing annually, not because of a bad investment, not because of a market crash, but because your bank is paying you almost nothing, while the cost of everything around you continues to rise. This is not a uniquely American problem. In the United Kingdom, the Bank of England held interest rates at 3.75% at its first meeting of 2026, while inflation remains stubbornly above target at 3.4% as of December 2025. The European Central Bank held rates at 2% in early February 2026 after Eurozone inflation dipped, but many standard savings accounts across Europe pay well under 1%. In Russia, the central bank has maintained some of the highest interest rates among major economies, yet inflation there has also been running at elevated levels. The pattern is remarkably consistent across the developed world. Traditional bank savings, for the vast majority of depositors, are failing to preserve the real value of money. And the smart money, the institutional investors, the billionaires, the sovereign wealth funds, the sophisticated family offices, they already know this. They have been acting on it for years. The question is why more people are not paying attention. Consider what Warren Buffett has been doing. Berkshire Hathaway's cash reserves swelled to a record $381.7 billion by the third quarter of 2025, the largest corporate cash hoard in American history. But here's the critical detail most people miss. Buffett is not keeping that money in a savings account. Approximately $305 to $314 billion of that cash pile was invested in United States Treasury bills, short-term government debt instruments that were yielding significantly more than any standard bank account. At one point, Berkshire Hathaway held about 5.1% of the entire U.S. Treasury bill market. The company owned more Treasury bills than the Federal Reserve itself. Buffett has always said that Berkshire will hold a boatload of cash in U.S. Treasury bills, but the scale of that position tells you something profound about how the most successful investor in history views the relative value of bank deposits versus direct government debt. The movement out of traditional bank deposits is not anecdotal. It is showing up clearly in the data. U.S. money market fund assets rose by $954 billion throughout 2025, reaching a record $7.8 trillion. In just the first week of January 2026, money market funds recorded a net inflow of $148.5 billion, the third largest weekly inflow on record, according to data tracked by the Investment Company Institute. That money is not going into stocks, it is not going into cryptocurrency, it is going into instruments that offer what banks will not, a fair yield on cash. As Accenture Research has noted, as much as $13 trillion in transaction value could migrate to alternative financial methods by the end of this decade. The banking industry is watching a slow-motion migration of capital, and the people leaving are not reckless speculators. They are informed savers doing basic arithmetic. Let us walk through that arithmetic because it is the foundation of everything that follows. Suppose you have $50,000 in a standard savings account earning the national average of 0.6%. After 1 year, you earn roughly $300 in interest. But with inflation at 2.4%, the real cost of goods and services you could buy with that $50,000 has increased by about $1,200. Your net position in terms of purchasing power has declined by approximately $900. Now factor in taxes. In the United States, the interest you earn on a savings account is taxed as ordinary income. Depending on your bracket, You could owe anywhere from 10 to 37% of that $300 in federal taxes alone, plus state taxes where applicable. In the United Kingdom, higher rate taxpayers face an even starker picture. A recent analysis by The Times showed that a higher rate taxpayer with £30,000 in a savings account earning 4.5% interest would lose roughly 70% of their nominal return to the combined effects of tax and inflation. After taxes and inflation, a standard bank savings account is not a safe place for your money. It is a guaranteed mechanism for losing value. The Federal Reserve's current target range for the federal funds rate sits at 3.5 to 3.75% as of the January 2026 FOMC meeting, held steady after 3 consecutive cuts in late 2025. This is important because the federal funds rate heavily influences what banks can earn on deposits they lend out, yet the spread between what banks earn and what they pay depositors remains enormous. Banks are earning well above 3.5% on the money you deposit, and many of them are paying you less than 0.5%. This spread is not a secret. It is their primary business model. And for the first time in a generation, ordinary savers have accessible alternatives that bypass this spread entirely. So what are those alternatives, and how do you actually implement them? The first and most accessible option is a high-yield savings account, typically offered by online banks with lower overhead costs than traditional brick-and-mortar institutions. As of February 2026, the best high-yield savings accounts are paying between 4 and 5% annual percentage yield, with some reaching as high as 5%. These accounts are still FDIC insured up to $250,000 per depositor per institution, meaning they carry the same federal protection as your local bank's savings account, but pay roughly 10 times the interest. Moving money from a standard savings account paying 0.39% to a high-yield account paying 4.2% on the same $50,000 would generate approximately $2,100 in annual interest instead of $195. That is not a speculative return. That is simply choosing the better version of the exact same product. The second option, and one favored by Buffett and institutional money managers alike, is direct investment in U.S. Treasury securities. Treasury bills, which mature in 4 weeks to 1 year, have been yielding in the range of 3.6 to 4.3%, depending on maturity. Treasury notes, which mature in 2 to 10 years, are yielding around 4 to 4.5% on the 10-year benchmark. These instruments are backed by the full faith and credit of the United States government, making them among the safest investments on the planet. Critically, the interest earned on Treasury securities is exempt from state and local taxes in the United States, which gives them an effective after-tax yield advantage over bank deposits and even some high-yield savings accounts for residents of high-tax states like New York and California. You can purchase Treasury securities directly through treasurydirect.gov with no fees and no middleman, or through most major brokerage accounts. The third option gaining significant traction is money market funds, particularly government money market funds that invest primarily in Treasury securities and repurchase agreements. These funds currently yield in the range of 3.5 to 4.5% and offer daily liquidity, meaning you can access your money quickly. While money market funds are not FDIC insured, government money market funds have an extremely strong safety record, and the underlying assets are backed by the U.S. government. The $7.8 trillion now sitting in money market funds is a testament to how many investors, both retail and institutional, have concluded that this is a superior home for cash compared to a bank account. For investors in the United Kingdom, the equivalent strategies involve shopping for competitive savings rates through platforms that aggregate offerings from multiple banks, utilizing individual savings accounts, known as ISAs, which shelter interest from income tax entirely up to the annual allowance, and considering short-dated gilts, which are the British equivalent of Treasury securities. In the Eurozone, where the ECB's deposit rate has stabilized at 2%, and many forecasters expect it to hold steady through much of 2026, savers should look at money market funds denominated in euros and short-term government bonds from nations with strong credit ratings like Germany and the Netherlands. Beyond these core cash alternatives, the smart money is also diversifying into asset classes that have historically outpaced inflation by significant margins. Gold surged more than 60% in 2025, its strongest annual performance since 1979. reaching new all-time highs multiple times throughout the year. As of mid-February 2026, gold prices have risen to approximately $5,043 per troy ounce, up roughly 75% from a year earlier. JP Morgan's research team expects gold prices to push toward $5,000 per ounce by the fourth quarter of 2026, with $6,000 a possibility further out. Central bank buying, particularly from China, India, and other emerging market nations seeking to reduce dollar dependence, has been a major structural driver. Gold generates no income, so it is not a replacement for a savings account in the traditional sense, but as a store of value and inflation hedge over long periods, its track record is measured in millennia. Equities remain the dominant long-term wealth builder, with the S&P 500 having returned an average of roughly 10% annually since its inception. Even the dividend yield alone on many blue-chip stocks and dividend-focused exchange-traded funds exceeds what standard savings accounts pay. However, stocks carry genuine risk of loss, and anyone moving money out of a bank should understand the critical distinction between capital you cannot afford to lose, which belongs in insured liquid instruments, and capital you are investing for growth over 5, 10, or 20 years, where equities have historically excelled. Now, this brings us to risk management, which is the part of this conversation that many people skip but is arguably the most important. Moving money out of a traditional bank account does not mean abandoning safety. It means being more intentional about where safety actually resides. FDIC insurance protects $250,000 per depositor, per ownership category, per insured bank. If you have more than that at a single institution, the excess is genuinely at risk in the event of a bank failure. The 2023 failures of Silicon Valley Bank, Signature Bank, and First Republic Bank demonstrated that depositors with funds above the FDIC limit can face real uncertainty, even if regulators ultimately stepped in to cover uninsured deposits in those specific cases. Congress has been considering raising the FDIC insurance cap, with one Senate bill proposing to increase the limit to $10 million for transaction accounts. But as of early 2026, no changes have been enacted. The standard protection remains $250,000. A prudent approach involves what financial planners call layered liquidity. The first layer is a genuine emergency fund, 3 to 6 months of essential expenses, held in a high-yield savings account or money market account where it is FDIC insured or invested in government money market funds and can be accessed within 1 to 2 business days. The second layer is near-term capital you may need within 1 to 3 years, which can be deployed into short-term Treasury securities, certificates of deposit, or bond funds with short durations. The third layer is long-term capital you will not need for 5 or more years, which can be allocated across a diversified portfolio of equities, real estate investment trusts, and other growth-oriented assets proportional to your risk tolerance and timeline. Tax considerations vary significantly by jurisdiction and are worth understanding before making any moves. In the United States, interest from savings accounts and certificates of deposit is taxed as ordinary income at your marginal rate, which can reach 37% at the federal level. Interest from Treasury securities is also taxed at the federal level, but exempt from state and local taxes. Dividends from stocks may qualify for the lower long-term capital gains. Tax rate of 0, 15, or 20% depending on your income, making dividend-paying stocks potentially more tax-efficient than bank interest for investors in higher brackets. In the United Kingdom, the personal savings allowance shields up to £1,000 of savings interest from tax for basic rate taxpayers and £500 for higher rate taxpayers, while ISAs provide a completely tax-free wrapper. In Canada, tax-free savings accounts, known as TFSAs, allow investment gains to grow entirely tax-free, making them an ideal vehicle for deploying cash that is currently sitting idle in a low-yield bank account. In Russia, individual investment accounts offer certain tax benefits for long-term savers, though the regulatory environment there has been shifting. The Deloitte 2026 Banking and Capital Markets Outlook described this as a pivotal moment for the banking industry, as institutions navigate macroeconomic headwinds, stablecoin disruption, the scaling of artificial intelligence, and increased competition for deposits. Banks are aware that they are losing wallet share. Net interest income improved by 4% in the first half of 2025 after declining in 2024, but the competitive pressure from fintech companies, direct Treasury access, and money market funds is intensifying. Accenture's 2026 Banking Trends report emphasized the need for banks to become platforms for trust, technology, and intelligence that make smart money move safely and purposefully. The language is telling. Even the consulting firms advising banks are acknowledging that capital is migrating elsewhere. For the individual saver or investor watching this, the practical steps are straightforward. First, determine exactly how much you have sitting in traditional bank accounts and what interest rate you are earning. Most people have never done this calculation, and the result is usually sobering. Second, identify how much of that money constitutes your emergency fund and move it to the highest yielding FDIC-insured or government-backed account you can find. Third, for funds beyond your emergency reserve, evaluate whether Treasury securities, money market funds, or a diversified investment portfolio better matches your timeline and risk tolerance. Fourth, understand your tax situation and choose instruments that maximize your after-tax return, not just the headline rate. And fifth, automate the process. Set up direct transfers, establish a brokerage account if you do not have one, and create a system that ensures your idle cash is always working as hard as possible. The realistic expectation here is not that you will get rich from these moves. You will not. What you will do is stop losing money to a system that has been designed to profit from your inertia. The gap between the best available options for cash and the standard bank savings account represents one of the largest and most widespread financial inefficiencies affecting ordinary households in the developed world. It is not dramatic. It is not exciting. But over 10, 20, or 30 years, the compounding effect of earning 4% instead of 0.4% on your cash reserves is the difference between genuine financial security and quietly falling behind. Looking forward, the trajectory is clear. The Federal Reserve is expected to continue moving rates lower through 2026, with projections suggesting a year-end federal funds rate target range of 3 to 3.25%, with additional reductions possible in 2027. As rates decline, yields on high-yield savings accounts, money market funds, and Treasury bills will follow. Bank rate projects that the highest nationally available savings rates may settle around 3.7% by the end of 2026. This makes the current moment a window of opportunity. The yields available today on risk-free or near risk-free instruments are historically attractive, and locking in longer duration Treasury notes or certificates of deposit at current rates allows you to preserve those yields even as the Fed continues cutting. The deeper lesson here transcends interest rates and inflation numbers. It is about financial awareness and the willingness to act on information that is freely available but rarely acted upon. The banking industry, across every developed nation, has relied for decades on the assumption that most depositors will accept whatever rate they are given without comparison shopping. That assumption has been extraordinarily profitable for banks and extraordinarily costly for their customers. The data is unambiguous, the tools are accessible, the alternatives are safer and more profitable than what most people are currently using. The only remaining variable is whether you choose to act on what you now know. The smart money has already moved. The question is whether the rest of us will follow before the window of opportunity narrows further.